actually decide to get out and take your misplacements. But I hope you didn't. So, but we'll talk about that later on.
I did not. I'm still in there.
Good, good. Did you have a look at it before the bell?
No, I lost service
Okay.
when I was, yeah, I
Well, you
lost
got a chance
service.
to look at it because you should be up.
I'm I'm gonna check now, but I'm it's really hot here, so I'm a little uncomfortable.
Okay.
I'm going to check. Let me check now.
It's okay. You'll know in the morning. So if you guys are ready, anybody have anything else to say, questions, comments, or concerns? Good. I didn't expect any questions. You guys won't even speak to me, so I didn't expect any questions.
I already spoke too much. That's why I'm keeping quiet.
Michael.
I said I'm just keeping quiet. I spoke.
No. It's all good, guys. If y'all ready, we can get right into it, okay?
Let's go.
All right. Say what? Okay. So, volume. Hold on, let me move some screens around. Now I can't see anything. Okay, that's better. Bear with me. All right, guys. So today we're going to talk about volume. Understanding the volume, Three Kings mentorship, right? So, okay, that didn't work like I thought. Let's try it again. There we go. Disclaimer. This is not financial advice. This is for personal investment and educational purposes only. I'm not a financial advisor. Cannot tell you what to buy or sell. All investments have risk, and it's important to conduct your own due diligence while practicing risk management. Everybody good with that? Just shake your head. Okay, cool. Okay, so different types of volume is what I want to talk about tonight. So we have the volume versus average volume, okay? So let's talk about it. Volume. What is volume? Volume refers to the number of shares or contracts in the case of options that are traded during a specific time period, usually measured daily. Okay. Context. When you check the volume of a stock on any given day, you're looking at how many shares have been bought and sold during that particular day. This number fluctuates throughout the day as more trades occur. Okay. Use case or use. We look at the current day's volume to understand how much activity is happening in the stock at that moment. A spike in volume could indicate heightened interest due to news, earnings, FOMC meetings, or other catalysts like today. Okay, everybody got that? I don't know if anybody paid attention, but like yesterday, NVIDIA ran. The average volume was around like 200 something million. When I looked at the volume for yesterday, it was like 572 million. Okay. Any questions on this so far? This is just volume. Any questions? Okay, let's keep going. So then let's talk about average volume. Average volume represents the average number of shares traded over a specific period, typically calculated over 30 or 50 trading days. Sometimes other intervals like 10 or 100 days as well. Depending on what sites you use, some sites will show you the 10 and the 100 days as far as the average volume. Okay. But typically when we see them on platforms, it's usually the last 30 days. And what I've seen is normally it'll have a little 30-day in parentheses to kind of indicate what is the average of. Okay, guys? Cool. So context. This metric smooths out daily fluctuation by showing how much trading activity usually occurs on a regular basis. It helps gives us a sense of what's normal for that stock. Like I just mentioned, NVIDIA's average volume, I think, was 200 something million. Don't quote me on the numbers. It was 2 something. And we noticed yesterday that it was up higher than average, right? Right. Okay. Average volume is useful for comparing current trading activity with the stock's historical activity. If the current day's volume is much higher than the average volume, it could indicate that something significant is happening, like a news event. The volume is lower, excuse me, if the volume is lower than average, the stock might be trading more quieter than normal. Good on that? So we understand the difference between average volume and average volume and why we use those.
Got it.
Good?
Good.
Okay. The key differences. So let's break down the differences, okay? Somebody needs to turn their Discord off. Is it me or is it Michael? Okay, let's mute. Okay, I'm just gonna mute everybody for now. And then you guys can unmute yourselves if you have a question, okay? Shake your heads. Everybody hear me? Everybody good with that? Cool. Current versus historical. So, of course, volume is current, right? Volume is a real-time or current day measure of trading activity, while average volume gives a historical perspective on how much trading activity usually happens over a period. Volatility insights, right? Comparing the current volume to the average volume can help traders assess if there's unusual interest or activity in a stock. If today's volume is far above the average volume, it may suggest increased volatility or potential price movement. Again, we saw this yesterday within the video. It also helps us find the trend strength. And as you know, most of us are momentum traders. So we trade the trend, right? Average volume can help validate trends. A stock moving up or down higher than average volume may have a stronger, more sustained trend. In contrast, if a stock is moving on lower than average volume, the trend may lack confidence. Lack convictions. All right. So when we think about that, I think I spoke on this maybe yesterday or last time. Sometimes you guys will hear me say, I don't trust it or it's hollow, right? Because we see these big jumps and things are moving, but there's no volume behind them. So for me, I like to say that's hollow. If they're moving and there's no volume behind them, then there's a chance that it's not going to sustain, right? Any questions there? Go ahead, Ghost.
Is there a certain amount under the average that you would call it, you know, where it's not that volatile, or?
Yeah,
Well,
like
for me, if I under average, this means it's probably typically low for that stock, right? And if it's low volume, then there's not much happening with it. You may not want to play it.
Right.
Good.
Yeah.
Did I answer your question correctly?
Yeah, yeah.
Okay. Any more questions?
Yeah, King. So just like how you captured last week. So for example, I'm assuming, and let's just say ASML, was, had a high volume today, or maybe can you please show an example of what stock had extremely high value against its average? Just how we could see that. Do you have an example?
Okay. One thing about you, John, is you always want me to stop my presentation to show you something on the chart.
He said if it had questions.
No. Let's just do that at the end. No, I
Okay.
promise we'll come back to it. Okay. And ASML, I think Neil played that. So we can look at that also on the chart. Just any other questions besides things that are going to take me from my presentation? Yeah, go ahead. But if they're gonna make me deviate, just hold them for a second. Okay, guys? Because I'm really calm and I really love presenting in front of 30 people. So I just love this part of it. Okay, guys?
You got this, brother. You got it.
No, it's all good. But I appreciate you, John. Because we gotta add a little spice to these things sometimes,
Absolutely.
But that's a great question. So we'll go through that because I'm sure somebody else wants to know the same thing. So don't, if y'all have questions, just ask them, guys, and we'll work through it. But everybody's good here. Okay, I got my starting 7 nodding, so they speak for everybody else. Let's go. All right. So Okay, in summary, volume tells you what's happening with the stock right now, while the average volume provides a benchmark to compare today's activity against the stock's typical trading patterns over time. Make sense? Cool. Everybody saying yes? I did a good job. Okay, let's keep going. So let's talk about volume in the case of stock options because there's a difference, right? The volume we're referring to is the volume of the asset. So now let's talk about volume when we're looking at stock options. So some of the key factors that volume is going to affect, or some of the key things that we are looking for when we're looking at the volume. One is going right off the bat. I think me and Mark or me and Neil talked about this, or Neil and I talked about this yesterday, but liquidity, right? When we're looking at those contracts, we want there to be volume there so we can so there's liquidity. So let's go into it. Volume represents the number of contracts traded during any given period of time. And this is in the options. This is volume as it refers to options contracts. Okay. Cool. High volume indicates that many traders are interested in that particular option, making it easier to enter or exit positions quickly without significantly affecting the price. Low volume, on the other hand, means fewer buyers and sellers, which can lead to a wider bid-ask spread and more difficulty executing trades at desired price. Don't laugh at me, John. I have to say it slow because it's a tricky phrase. Bruh, I have to just slow down and say it, okay? I see you laughing. At least turn your camera off, bruh. Okay. Does everybody understand liquidity? If not, I can read it again. Everybody good on that one?
I want to hear it again.
This is recorded, guys. Please. No, all good. So another thing, market sentiment, right? Volume can give you clues about the market sentiment toward a stock or option. When there's unusually high volume for a specific option, it could signal that investors are expecting a major price movement in the underlying stock. This could be based upon earnings, news, or other catalysts. Higher than usual volume often accompanies a strong trend, suggesting confidence in the direction of the move. Again, when we look at these contracts, if that happens to me, I'm not gonna say all the time, but it happens often. I'm looking for something, I'm looking at contracts, and I'll see a lot of volume and open interest loaded at one particular strike price, right? Let's say AMD. I see a bunch of volume at the 150s or a bunch of volume at the 160s, right? When I see that, when I see those stacked like that, when I see at those psychological numbers, it lets me know that someone believes that we will get to that price. And a lot of someone's believe that. So there's just a little tip I kind of run into, just something to help me make my decision. When I'm looking through the option chain and I see that there's a lot of volume in certain options, that could also suggest that they're expecting a move. So market sentiment would tie into that. Everybody good on that?
Yeah. So King, for example, so like let's just say you look at not Earner Whispers, but the can think of the website, but as you mentioned, it gives you the option chain so you can see the market sentiment, you can see the dark movement. So when
30
you're
ticks?
like, yeah, exactly. Thank you. Exactly.
Mhm.
So if you're viewing that, so you're looking at that, why I'm assuming that you're looking at entries either on your chart or on your brokerage. So before you make a decision, you go into that and say that, hey, you know, I'm gonna look at this play per se, and then as I see my chart indicate, I'm gonna look at this first, then make my play and then my exit. Is that kind of how you
So
use that?
yeah, typically I'm going back most of my decisions with technical analysis, right? But upon looking at the play, let's say I'm looking at the options chain and I decide to how do you say it? I decide that maybe I want to do the 150s, but I also noticed that there's a lot of volume at other strike prices, like high volume at strike prices going in my direction. That can kind of give me an inkling that not only do I expect the market to go up, but so do thousands and in some cases millions of other people. If we look at the options chain and we look at those, like especially anything in like increments of 5, like the 125s, the 130s, the 145s, the 150s, they're all stacked. That lets me know that somebody knows something and they all expect for the price to go this way. Now it's the opposite if we're looking at puts. If we see a lot of high volume on puts, then we expect, okay, maybe someone thinks this is going to pull back. But again, we use all of these things, but this is just a tip when we're looking at volume, why volume matters. Because if we're just going to make a trade and we never look at the volume on the contract, we may miss something. We may decide, okay, well, there's a lot more volume in open interest at the 150s, and it's a better delta for me. Maybe the theta is better, maybe it isn't, but this may be a better contract. But again, when you're looking at the option chain, if you see thousands of people stacked all the way up as you go up the option chain, that can give you an inkling that stock, that particular stock is bullish or expected to be bullish within that time frame. Make sense? Make sense, John? All right, I'm going to guess that you said yes. You asked the question and then disappeared. But does anybody else have any questions? Do you all understand what I'm saying?
Where do you see the option like volume? Is that just when you're buying an option? It just shows it on that screen usually?
Yes, Michael.
Got it.
Yeah, it's going to definitely be on the contract that you purchase.
So it doesn't show it in trading view. Like when you're in trading view, could you see it there, or do you have to just go into your like trading account and see it there?
No, there's an option in trading view that'll now they'll let you see like options down at the bottom on the right-hand screen. And you can see the options chain.
Got it.
Any options chain is going to show volume.
Got
It's
it.
going to show the volume of that contract and open interest. Okay. Anytime you see an options chain, okay?
Thank you.
The volume on the options chain refers to the whole market, not just the broker, correct?
Right, for sure. Options are universal. The brokerage is just the middleman.
Got it.
Yeah, me and you could buy the same option with different brokerages. Cool. Any questions? Okay, cool. So another reason we want to always pay attention to the volume on the contracts. So confirmation of price movements, right? Volume can help confirm the validity of price movements. If the price of a stock or option is rising or falling on high volume, it suggests that the movement is backed by significant interest, or it may be more likely to continue. On the other hand, if the price if the price move happens on low volume, it may indicate that the move is weak or temporary or could reverse. Okay? Any questions there? Options premium pricing. Volume affects the price of an options premium. The cost, that's what we buy. When we buy it and it's $4 or $5, that's the cost of the premium, right? The cost of buying the option. High volume typically results in more competitive pricing as more market participants are vying to buy or sell the option. Low volume, however, can result in more erratic pricing and higher premiums due to less competition and liquidity. Going back to the bid-ask spread. Okay. Cool. Volatility. Volume can be an indicator of potential volatility. High volume often corresponds to increased volatility as many traders are repositioning based on news or events. For options traders, understanding volatility is crucial as it directly impacts the price of options to implied volatility. I know you guys are wondering what implied volatility is. Just hold tight. In summary, volume helps traders gauge liquidity, assess market sentiment, confirm price trends, and understand potential volatility. All key factors in making informed trading decisions. Everyone good? Okay. So we have a bonus, right? So we talked about volume, and you guys, I feel like you guys understand volume so far, right? And then we talked about volume, how it affects options contracts. We can't talk about volume without talking about implied volatility and open interest. Okay. So this is the bonus, guys. You guys don't look that excited. Like this is a gift. This is a bonus, guys.
I'm excited. I'm very
Okay. Don't be ungrateful, guys. Like,
No.
come
awesome. This is very helpful.
All right. So let's talk about IV. Implied volatility is an estimate of the stock's future volatility and affects option pricing for sure. And with all of these earnings, we're going to get a crash course on that come tomorrow. So high IV usually means options are more expensive, good for selling options. Also suggests more uncertainty. So let me just tap into that a little bit more. IV is the expected move, right? So you see the IV shoot up around earnings or like big announcements and things like that. And for me, it's just kind of like a luxury tax. It's the expected move, so it just kind of adds more to the contract because so many people are expecting it to move in a direction. Excuse me. So for me, it's just like a luxury tax. Everybody good with that?
Yes.
Cool. Low IV usually means options are cheap, better for buying options, also suggests more stability in the markets, right? Because if the IV is high volatility, we already know when there's volatility in anything related to this market, it's going to be a rougher ride, right? Yes? Cool.
Yeah.
All right. So I know you guys are wondering, what are the typical ranges? Because they vary. And again, don't quote me on these. I got these off of Google. Okay. I Googled the ranges. They looked good to me. So don't quote me, guys. But I just wanted to give you guys an idea, a typical range. Okay. Large cap and stable stocks like Microsoft or Apple, usually the normal range is from 15 to 25%. Okay. In calm markets, it may drop to 10 to 15%, but while in high volatility environments like earnings, market downturns, it may spike to 30 to 40% or more. And this is going to be for blue chip stocks or Apple and Microsoft. Okay. Everybody good on that? Everybody understand the difference? Okay. So let's talk about growth in tech stocks, Tesla and Amazon. Generally, you'll see the IV between 30 and 50%, of course, because these are growth stocks, right? So they're going to be moving more. They're going to be more volatile, right? IV can surge above 60 to 80% around earnings or specific events, especially in tech stocks with higher speculation. So remember, the IV is all based on the speculation, right? Everybody good on that? Yeah. Either I'm a great teacher or y'all smart as I don't know what. Because some of this stuff, the first time I read it, I wasn't that sure, but I'm glad you guys are getting it.
Sure.
Okay, let's move right along. Small caps and highly speculative stocks. Of course, if IV is based on speculation, those ranges are going to be from 50 to 100% or even more. I see higher IV in like newer penny stocks for sure. I don't really deal with them a lot, but that's just my perspective. Small cap stocks are subject to higher volatility due to lower liquidity and greater sensitivity to news. So they frequently show elevated IV levels. Simple. Nothing there? No confusion. You guys are flawless. All right. ETFs. So you guys know we like to play a lot of SPY.
If there's something we're missing, tell us what we don't know. I feel like I'm not smart enough to ask a question in these moments, but I feel like you know the question behind the question or the layer. Like, treat me like I'm stupid. Crayon and a piece of paper.
I've been waiting for this all my life.
Let
Treat you like you
me
what?
sacrifice myself on the altar of I can't afford bad trades.
No. It's no, actually it's all good. We try to make this as simple as possible. I think you guys especially the main people. You guys, I mean, are pretty used to my teaching style. I try to break it down for you all. You're not missing anything. The beautiful thing is that you guys get it, right? And that's another reason I love these mentorships, because we've kind of grown together. So you guys kind of already know what I mean when I say certain things. So it isn't much confusion. Unless you guys are just being nice and don't want to ask questions, but it looks like you all are getting it. The people's whose cameras are on.
Actually,
I guess I'll ask then, just to follow what Garrett was saying. So
Where you come from?
I had my little one back here, so he was cutting
Okay,
up.
man. Don't ask another question and then leave.
Hey, no one's going to ask. So implied volatility. So I know Neil, if you're going to get into it later, I mean, then I'll stop. But how does, I want to see how that affects, right? Our plays, if it kills the delta, or the theta, things of that nature, just to
Yeah,
so I can kind of understand.
cool. Neil's gonna cover IV crush, and that's gonna
I'm gonna
give
talk
you
about that
yeah.
later on.
IV can help or hurt you.
Called crush for a reason.
Yeah, yeah, and not the good kind of crush. Okay, so let's sector specific or leverage ETFs may show higher IV around 25 to 50%, especially if they're tracking volatile sectors like tech or energy. Makes sense, right? Okay, guys.
Yes,
Thank you, Joy. Thank you for that.
you're welcome.
Okay, so still covering IV, event-driven IV spikes, right? Earnings announcements, news, mergers, macroeconomic events like Fed decisions often increase IV temporarily. Cool. So, King's Gym. Check the check the stocks IV on platforms like Google, Market Chameleon. I really like Market Chameleon because you can move it around and break it down. That rhyme, but I didn't mean to. Trading View, Option Strat, or even your brokerage. If the IV is high, you can make more because the chance of profit is higher. But for newer traders, you may want to avoid this particular stock because it can increase the risk. Okay. Good.
Mm-hmm.
Okay, so let's talk about open interest. Open interest, you guys have heard me mention that. We talked about it a little bit here and there. Open interest is the number of contracts not yet closed. High open interest typically suggests strong interest and liquidity in the contract. It's just that simple. Open interest that's what you're looking at. When you're looking at open interest, you just want to see the number of people that are still there or that are holding those contracts, okay? Because that can also give you an inkling when you want to make a decision on which contract to buy. Remember, the contracts are our product. We're investors and we're investing in products. The contracts are the product. So we want to buy the products that are in higher demand or the products that are going to be easier to move. So one of the main reasons we add time to our products to give ourselves time, right, to move the product, i.e. the contracts in this case. Good?
Good.
Cool. So when we're looking at the options chain, we want to look at all of these different things, okay? So avoid options with very low volume, less than 1K and open interest, less than 1,000, okay? And that varies. I don't want y'all to stick to this because we buy contracts all the time that don't have a lot of it, but I'm just giving you a general basis, right? So especially for contracts that on stocks that are pretty that are trending or bigger stocks. I don't know how to say it, but the Nvidias, the Teslas, the Amazons, things like that. When you see low volume under 1,000, you may want to look for a better contract. Okay.
Would that also have to do with how long we're planning to keep it? Like if we're trying to flip it, we need a product that has quick interest. If it's maybe a lotto play, we're not necessarily considering that because, we might be buying 3 months because we think something could happen between now and then. We're just buying it because it's cheap to kind of see what happens. Like we could see would that kind of play into that too?
Well, I can't really answer that because I don't really buy lottos. I don't really like to gamble. So I don't really buy products and then I just hope they, work. So I don't really know about how they affect lottos, but I'm looking at the open interest on any contract because I want to know who's holding those products also with me, so I have someone to sell it to. But also it gives me an inkling that when I see a lot of open interest, I can't be the only one that thought this, right? Obviously, a lot of other hopefully smart people or analysts thinks the same thing. That's why we're looking at open interest, because we want to see who's already there. Make sense? Did I answer your question? Partially? Okay, appreciate it. So, where was I at? Oh, okay. Avoid options with very low volume as they may have a wide bid-ask spread, making them harder to trade profitably, right? Rule of thumb, volume should be substantially greater than the open interest in a tight bid-ask spread. 1 cent to 5 cent is cool, but it can vary for large versus mid cap stocks. Usually the mid caps it may be okay. A 5 to 10% gap, that's okay, right? But when we're buying these contracts, we don't want the bid ask spread to be too big, right? We don't want it too wide because then you won't be able to get filled on either end. You may have a harder time getting filled. Does that make sense?
Yeah.
Okay, if the contracts are going for $2 on the bid and then the ask is $2.50, then you know you're gonna have trouble trying to get in at that contract because you have so much space in between. You may get filled at $2.40. $2.40 is a long way. That's $40 from $2. Okay. Cool. Guys, you got a question?
No.
No, me.
Okay, cool.
Thank you.
Okay, well, I just see the mics come on, so I just thought maybe you had a question. Everybody good on that?
I do have a question. When you say the volume should be substantially greater than open interest, but what exactly do you mean by substantially?
So that's gonna be up to you, but I'd like to see much higher volume than open interest because that's letting me know what's happening for the contract that day, and its people are already there. Okay, does it make sense? So it's going to. I don't have an actual number for you. If you want me to be honest, see, I don't like to just throw around numbers because you guys stick to those, and I don't want you to be in a play and you're like, well, King said over 1,000 and it's at 800. I don't want to, I don't want to warp you all like that. Okay. So I want you to use your best judgment, but higher volume than open interest is usually a good scenario. Okay.
All right, thank you.
No problem, Gabe. Everybody good on this part?
Yeah.
Sure.
Just so I'm clear, open interest is just like the volume is the actual volume traded in the contracts, and the open interest is just people who are looking at it.
It's people who are holding it.
Oh,
People who own it. People who already bought that contract.
Oh, and the volume is what's traded that day.
Correct.
Oh, I see. Okay. Thanks.
Cool. No problem. Okay. Conclusion. In conclusion, volume is extremely important. It is the fuel that drives the asset, but also can provide a roadmap to the direction. Does that make sense? I wrote that all myself, guys. All by myself. I came up with that. Like it? It's good.
Yeah.
All right, guys. Thank you. That's enough.
That was great, King. That was great.
Thank you, King.
No, it's all good, guys. Joking is how I get through this with you all. Okay, so I know Neil's gonna talk about IV Crush. We got to talk about it after talking about IV. John had a question for us that he would like. He's gonna work us today, Neil. That's what he said.
That's why we're here, right?
No, it's all good, guys. We enjoy this. All right, I hand it over to you, Neil.
I'm actually not ready yet.
Okay.
I'm trying to find something. Only because I didn't plan on talking about this, so I didn't prep accordingly. So it's like now I'm trying to put everything together last minute. There's one thing I am, and that is a planner. So when I do present this to you guys, so please be patient with me in regards to it, because I want to make sure that you guys are getting the correct information, and not only it being correct, I want it to actually make sense, right? So so I'm just trying to put some finish because I set it up as a presentation, just so for the sake of when you guys watch the recording, now you can actually see it in real time. So I'm trying to set up some examples. But like I said, had I known I would have been talking about Ivy Crush today, I would have took the original snapshot of what ASML, what their implied volatility looked like prior to the ending of the day, or prior to buying the actual contract. So this way you guys can see what it was like then versus what it looks like now. So pretty much now I'm showing you the aftermath. But I do have an example of Meta, because I know Meta, they had their earnings today. And I'm going to show you what their implied volatility looks like. So now this time tomorrow, I want you guys to go back and look at the same strike price, same expiration date, and you're going to see the difference, because you can see how Ivy Crush actually works before and after, and how it all makes sense.
Okay. Well, Lena says she checked. Yeah, Lena, Neil just wants you to take a look at your position. I'm assuming that it's up.
Yeah. Are you up?
Yeah, so do you want to just walk them through it, or you want to continue with the presentation, or where do you want to go with that?
Let me finish. I'm almost done with it, because like I said, I want to make sure for recording purposes they're able to go back in case anybody misses what we're talking about.
Absolutely. Okay. Well, take care of that, and I'll open it up for questions. Okay, go ahead, John and Mike. I'm all yours.
King, could you maybe like now that the market's closed, like let's say that for tomorrow morning that you are about to have a play, could you like maybe like go through an example of like how you like your mindset in terms of looking at the IV and the open interest, sorry, the volume and the open interest? Could you just give us maybe an example? Because I feel like that might help.
Is that Sam? Yeah,
that's Sam.
Asking me for something? No, it's all good, Sam. Yeah. So the open interest, that's going to be on your contract, okay? The open interest and volume in the case of contracts is going to be on your contract. So only time I'm looking at those is when I'm looking for contracts to purchase. Well, it's nothing really I would look at tonight. The volume is something that I look at in the morning. And simply, let me show you. I can show you on TradingView. Give me a second.
Yeah, I don't see on TradingView where they show. I'm in TradingView now, but I don't see like where the option, like the interest is.
No. I repeat your question, Michael.
I'm in TradingView, so I was just trying to see if you could show us, if you're going in TradingView, where the option, like the open interest and the volume is on the option contracts in TradingView, because I don't see it.
Okay. No problem, Michael.
Thank you.
Let me pull up
Michael,
trading.
you can also see that on your brokerage when you're looking at the contract price. It'll show you right there.
Right.
Yeah, I'm hoping that I could see it on TradingView also. So let's go to something that I haven't played a ton of. Well, not that one. This will work. So here's SPY, right? And as you see, this is the old flawless setup. I still use it. Okay. When we're looking at the volume for the day, it's going to be here. Okay. I think we went over this last week, but see, average volume 30 days. Okay. The volume, the actual volume was 37.12 million. The average volume is 55.9 million. Okay. So when you're looking at TradingView, this is one place to find the volume. And like Oscar said, say that again. Okay, I thought someone said something. Like Oscar said, anytime you buy any contract, the open interest and volume is going to be present. I'm hoping TradingView will show it to us. I don't use this often, but I don't want to open up my brokerage for you all. So, is it showing the Greeks? Let's see.
I missed how you got there.
Yeah, what did you click on? I didn't see that either.
Okay, I'll go back. Give me one
Oh, I
second.
see it.
You saw it at the bottom? It's here.
Oh, no, that's not what I saw.
Okay, so look, when you're looking at the ticker, right? You go to the right-hand side of the chart, right? Scroll down to the bottom section here, just under where we were looking at volume. Right? Everybody see that? And then you go all the way to the bottom. And TradingView now offers more on options. I don't use this often. I was just hoping that we could pull it up to see the volume and open interest, and now it's showing the Greeks. Theta, gamma, delta.
That's sorry to cut you off, King. It's a new tool that I've been using and learning how to use it. I'm actually trading with the option, the premiums chart next side by side with the actual chart. So this is something maybe I can show you guys and maybe later on.
No, you
It's
got
a
to
neat tool.
pull it up.
I'm sorry.
Yeah, you should have permission to share. You saying you want to share?
I'm not home. I'm running around, so I'm
Oh,
on my
okay.
phone.
Oh,
But
no.
I should be home in a few. If we have time, if I get home before we're done, maybe I can show you guys how to use the premium chart with the options chart. I mean, I'm sorry, with the regular chart. So as the price of the stock is moving, you can see the premiums moving as well. So it's pretty neat.
Where are you using that on Trading Ticks, or what are you using?
No, right there on oh, I'm sorry, I said I'm running around.
Oh, on TradingView.
On TradingView, so I do a split screen. I do two screens. So let's say if I'm trading NVIDIA, you pull the regular chart, and then you also pull the option. You can pull the options chain, and then you can pull the contract that you're trading, and you do them side by side. So as the price of the stock is moving, you see the price of the premium moving as well. So you see a premium chart. So
Okay,
so that
so
way you can back test. I've been using that and it's been pretty neat. And as the price is moving, I can see it moving as well. So
yeah, well, I don't know how to do that on TradingView. I use TradeStation, and they show me how
yeah,
to track my contracts through my brokerage.
right. Yeah, but it's a tool. Maybe if we get enough time, maybe I can show you guys how to do it.
Or you can tell me, maybe I can walk through it with them now.
Yeah, go ahead. Yeah, so just opening NVIDIA. Do a split screen. Do two screens, and then just pull the ticker, and then you go and then you open the option like you were showing before, and you can pick a contract. So let's say you pick a 131, 125 put or something like that.
So go back to more options.
So now go as you we're gonna search for a ticker on the left side.
Okay, so we got SPY there.
Yeah. So now you search whatever ticker you have. I can't really see because I'm on my phone.
Okay.
If you have SPY or NVIDIA, I think will be easier. All right. So go SPY. So now go back to SPY like you were searching the ticker on the left side. Okay. Yeah. There you. No, you gotta have to do it in the search on the left side. So select the screen that you want. Yeah. Select the second screen. Okay. Now select SPY again, and then go to options on the right side.
Oh, I see what you're talking about.
You know what? I think I did know about this.
Yeah, so you click on it, and then you can find the contract that you're trading.
Yeah, I think.
And then you can put it side by side, and you can see as the price of the stock is moving, you can see the price of the premium moving with it simultaneously.
Yeah, thank you for that. I did know about that. I just don't use it on here.
Oh wait, now I don't.
My brokerage shows the same thing, but that's cool. You can watch the price movement on the left, and then
Yeah,
a particular contract.
and you can back test it too, so you can see, okay, you missed the move, you had it there. You can actually see how the price of the premium moved along with the price of the So it's
Well,
been a
that's
neat tool that I found it like 2-3 weeks ago, and now I trade like that. So I'm watching the price of the stock and the price of the premium, and then I can mark my levels from there.
So show me one more time, King, how you got the SPY option there.
Okay. So when we go here,
Yep.
I'm controlling the right side of the screen now.
Yep.
So let's do it over, okay? Let's take it out. Start over. So when I type SPY here,
Yep.
so I got SPY on the left, and then I type SPY here. And instead of having all, because this is what pops up normally, right?
Right.
Go to
You
options.
click options. I see it now.
And then it took you to the SPY options chain. And now you can pick your particular contract that you have, right? And add it to the other screen. And this is a good point, and I'm glad Oscar brought this up because I think I've seen this before, but I didn't use it because I'm used to my brokerage. I have it up on another screen, and it'll show me, I can track my contract, right? But the good point about that is, like I spoke to you all earlier, options are our product. So if we can remember, the price movement affects the price or the premium of the option contract, right? We're watching price movement on the left to see how much we can get for our contracts. So I'm going to probably implement this tomorrow because then now I don't have to look at my brokerage screen. I can look at both of these side by side. So as the price moves, we can directly see how our options premium moves. Does that make sense to everyone? And that's good to know because options are what? Our products. So I know if I bought something here, right? Let's say I bought this option here at 497. This chart will also give me other levels, right? At one point I bought it for 497, but at one point this option got all the way up to $12, right?
Okay, so if you link I don't know, like I said, I'm driving it on my phone, but I don't see it. So if you see it, you can put the same time on the chart. Do you have the left chart open with SPY?
Yep.
Okay, so if you link the same time frames, you can actually drag along the time and the frame, and they will show you on the other screen what you're hovering over.
Okay.
I don't know if that makes sense, but what I'm trying to explain.
A tad bit.
So if you open them, literally, if you do like, one day chart, 10-minute,
Yeah, like this.
each. Yes. So then it will show where it was at that time.
Right. Okay. I see what you're saying. If you guys are looking at my cursor, it's moving based on the same exact times.
Mm-hmm.
Does it make sense to everyone? Like right now, I'm at 1300. For at the time of the option, also at the time of SPY. So if I move to 1400, it's going to show the same thing. Okay. On the left. You see, it's mirroring my cursor. But this is good because price is what we follow because it affects our premium price, right? But if we can watch price to kind of get an idea of what our premium is doing, sometimes the price doesn't affect our premium like we think, right? Sometimes the price may move sharply and move our contracts a lot or a little. Sometimes we see price not move much and the contracts move. Again, it's all based on the product that you bought. That's why we want to make sure we buy good or decent product, not decent, good products with open interest and volume. Okay.
Are you seeing like the change of the price of the option in after hours like stocks, or you don't really see what the option is doing until like the market's open?
Until the market is open.
Got it.
Yeah. I mean, because it's not being traded, right? So once it's like right now, if we look at our brokers, those contracts are going to reflect when the market closed. Okay.
Right.
You have to be live to be able to see it, basically.
Right. But what we're getting at is this tracks the actual option contract itself. And we don't want to get confused. We're looking at price to determine our premium contract price. Okay. Price will determine our option price. So this is a great tool that Oscar has given us, another great tool, right? Because now instead of I watch my contract all the time. So what you all will learn to understand, the deeper you get into this stuff, I buy contracts based on their price and my profit. Usually when I buy them, I've already looked at the delta and I know how much profit I'm expecting to make. When you start to buy multiple contracts in 20s and 30s and even hundreds, right? The way these contracts move are going to dictate a lot. Okay. So let's just say if you buy a contract that is at $5 and you have 100 of them, right? But at some point, price did something that made the contracts go up to $6, right? Maybe price didn't move a lot within that moment, but you got a dollar move on your contract. Make sense? And the dollar move is going to be $100. Times that by 50 contracts, that's good profit. Even if it's a 50-cent move. I watch my contracts like I watch the chart. So this is perfect for that. Does it make sense?
It's a lot easier to identify where you want to get out, or to identify your price targets as far as the contract price, not just the price of the stock. So once I started implementing this tool, it's a completely different ballgame. So I'm watching the price of the contract, how it's moving, the stock of the stock price. So now when I'm locked in, I flip my screens. This is my setup when I'm in the trade. And when I'm trading, this is what I'm watching. I'm watching the price of the contract as the price of the stock moves, and it's been a total game changer. So
yeah, this is a game changer. Especially
and I keep it simple. No indicators, nothing. So the option is completely plain. It's literally candles. That's it. Like red and green candles. That's it.
Yeah, all of this stuff will be off when I do that. It just popped up naturally. But again, guys, this is clutch because I usually put this stuff on an entire different screen where I'm tracking my contracts. But now you can just look at both. If you have limited screens, this is going to be clutch because sometimes price can move in a direction and you may think it's a big price move, but it didn't affect the contract much based on the contract that you bought. So Oscar giving us this tool where we can kind of figure out like, okay, how much the contract moved and see it numerically. This is dope. I've been using my brokerage to do it, and it's not as simple as this because I know TradingView and I have it up around me all the time. So this is going to be awesome. I appreciate that.
Question, King, and thanks, Oscar, for that.
No problem, guys.
Is there a way? So let's say how we have different layouts built, right, with different indicators. Is there a way to add the same ticker? Let's say I want to look at SPY on all of my layouts. So versus me going and adding SPY on each one of them one by one, can I do it like in one go?
Okay, can you rephrase that for me? I don't understand exactly.
So for instance, like on the top where it says 2023 update, that's one of your layouts.
Yes.
Right. And similar to that, you probably have like other ones with different indicators on it.
Right.
So is there a way to add, let's say, SPY on all of them? Because let's say the ones that I've built, I probably have like some ticker over there, right? Because I saved it that way.
Are you able to share your screen?
Sure, I can share my screen. 1 second.
That'd be easier for me to understand.
I think if I'm understanding him, he's wanting it. He just wants to pick an indicator and SPY already be there.
Right. So,
you want to pick a chart layout and SPY already be there?
I mean that I can do, right? Because I can just save it with that. But let's say Now I want to switch all of these indicators to like now I want to look at SPY, but then I want to look at SPY on all of these.
Okay, yes, show me on your chart what you're trying to achieve.
Yeah, so
I mean,
basically he wants to in one move change all those tabs from Tesla to SPY.
right. So I was just wondering if there's a way to do that. Because right now, like to see all these indicators for this ticker, I would have to go in and pick SPY one by one.
So let me see if I understand correctly what you want to do. So looking at all of your tabs, you want them all to say SPY.
Correct. Yeah.
So it seems what you have to do, and this is based off of what I've done. You have to actually save the chart. So this way, now when you open up that chart under that specific chart name, it's always going to default to that specific ticker. If that makes sense.
But there's no other way to do it for all the layouts in one go. Because once I save it, now it's saved with this ticker, but tomorrow I could be looking at something else, right? Like
so
I might not be looking at Tesla, which I'm
going to say to that is, I think I understand now what you are trying to achieve. If there is a way to do that, I'm not aware of it, but I want you to be careful with overcomplicating the process. Okay. Just change it at the top and keep going.
Yeah, that works too.
Yeah, I'm
not aware of a way to do that either.
Yeah, I'm not aware. If I understand you correctly, I'm not aware of a way to do that except save it on the ones that you want. But for me, in this game, I have been successful because I don't overcomplicate things. Okay.
Cool.
And another thing you can do, going back to your screen, if you just simply put all of or any ticker you want to look at specifically. So on the right-hand side where it says watch list, right? You just simply add, however many tickers you're watching. And then for every screen during the process of you setting yourself up, just simply click it.
Yeah, true. Probably the quickest way to do it.
Click it, open up a new screen, click it, open up a new screen, click it. Right?
Yeah.
Because I know I haven't come across, and maybe that's something somebody has to reach out to TradingView to validate if it can be done. But whenever I'm opening up a new screen, and based on what I have in my watch list, if I'm trying to watch multiple tickers based on how many tabs I have up, I just simply do that. I open up a tab, click the ticker, open up a new tab, click the ticker. It's just a lot easier versus me physically typing it.
Makes sense.
Sure. Yeah, like you have the watch list on the right. I can see your screen now.
Right.
You just click through them. Yeah, and then you have a lot of tabs open at the top. You're gonna want to minimize some of those so that your so that your laptop, so that your device doesn't run slower. But okay, you don't have to share. I hope we answered your question.
Yep.
Sam, did you bring enough for the class? No, you didn't. Okay, it's rude.
Sorry, I thought I turned off the camera. My apologies. Sorry, it's the morning right now for me.
No, that's okay. That's why I said
stuff
it.
in my face.
That's okay. That's why I said it. I didn't know if you knew. But that's strike two.
I was recording, isn't it? Man, this is just.
Don't worry about it. Strike two in my book, buddy. Okay, Neil, you good?
I'm almost. Give me like 5 more minutes.
Okay, guys.
I'm literally, I kid you guys not, maybe 5-10 minutes prior to the call starting and up to now, I've been working on this presentation for you guys. So again, if it's not up to par, I apologize. I am a planner, so I really did not plan on doing it. So please bear with me. I know I talked about that I would do it in the chat earlier, but time just really got away from me today.
Don't worry about it. Just focus on getting it correct, and we'll just answer some more questions. I'm sure John has some.
You won't let that go, will you?
Nah. Nope.
What about
I'm gonna do what Neil said too, as far as taking those screenshots so I can better understand. So like I did some plays right before the closing bell, and I didn't even look at the implied volatility. Um, but I did take some screenshots, and what I'm gonna do, I'm gonna review in the morning and see how that affects. But like I was mentioning to you earlier, which I'm not sure Neil's probably gonna cover in his presentation, like he said, but being able to know what I want to do as soon as the play happens before I get into the play, where my exit is going to be. But my issue is I can't figure out how to put in a stop loss that quick, because like I'm trying to figure out the cost for the contract. It's like it moves so fast. By the time it moves, the price changes. You know what I mean? So I guess I got to figure out a tool that helps me figure out my stop loss strike price and the ask and all that. So
Cool. Well, one thing I'm gonna say is always look at the IV, guys, because the IV is it's a luxury tax. If the speculation goes away, so does the IV. And that's when you lose. Neil's gonna touch on that, but that's when your contracts are going to feel that. Because if you buy contracts with high IV, the premium pricing is going to be higher, right? Everybody thinks Tesla's going to do this. Everybody thinks this is going to happen. So the IV is through the roof. Remember, you're buying at the top when you're buying with high IV. Just think about it like that. Now, tomorrow, Tesla comes out, it beats, less speculation, less IV. So automatically that chunk is going to come out of your premium, okay? Make sense, guys?
what do you mean it's going to come out of the premium?
Once the IV drops, you're going to lose what was accounted for with the IV being at a certain price. When it drops tomorrow, it's going to be lower. So if you're buying contracts with high IV, you're buying with that luxury tax already on them. So like buying the day before earnings or before big moves, you're buying with that with that already baked in. So once the speculation dies down, because IV is controlled by speculation. Once the speculation dies down, and tomorrow everything resumes normal activity, or the day after, the IV drops on you, so it's the premium price. The speculation is gone, so you're gonna lose the IV on your contract and get crushed.
That part.
Make sense, John?
Now it makes sense. It's like having a tariff or a sales tax, and it goes at a high cost when you brought it. The item was hot,
Right.
and then the next day you're trying to sell the same item, you can't add that extra tariff or that sales tax anymore, so you lose that extra premium.
It disappeared. This is why you want to watch those earnings plays and big plays, especially when the IV is up, because you may be buying at the top. You may be buying with a luxury tax, as I call it. But it works for you if you buy low and then the IV spikes, right? If you plan on playing earnings and you buy way out, right? And then as the IV goes up, you get delta and some gamma on your contracts, but the IV also will bring the contracts up. That's how sometimes you see contracts and you're like, how did it get to that price? Right? It may be a combination of things. That's why it's good to sell the contract when the IV is high, not buy.
Got you. Kind of like Neil always says, he likes to buy cheap contracts. I'm like, I don't know what cheap is. I'm trying to get into the game. Like my order won't fill. I'm like, click, cancel, click, do it again. So, but that makes sense.
All right, I think I'm ready, guys.
Okay, any more questions
Let's go.
before we do that? Any more questions? Everybody good on everything? IV, open interest, volume. Everybody good?
And we don't have to mute everybody either, because it's the presentation is relatively short. And it's straight to the point. And then I'll answer any questions to the best of my ability once we get to the end. All right?
10-4, you got the floor, brother.
All right, cool. Wait, let me share the screen first. Can we all see my screen?
Yep.
Yeah.
Yep.
All right, cool. So, as always, what we talk about is not financial advice, right? We are not financial advisors. We are only discussing the tools, the tips, and the tricks that we use personally, right? And as always, when I speak about myself, I'm also definitely referring to King and Mark as well. We do indeed appreciate you guys for allowing us to assist you on your trading journey, right? So let's just jump right into it. So what is implied volatility crust, right? What investors need to know. So, and I know King spoke on this a little bit early, earlier. So, so if I do repeat anything he has said, please forgive me. It's just simply a part of the presentation. Okay. So, what is IV Crush? First, we're going to identify what implied volatility is, right? So, implied volatility refers to the market's expectations of how volatile a stock or any other underlying asset will be in the future. So, this is critical. This is a critical factor when pricing options. So the higher the IV, the more expensive the option become as traders anticipate larger price movements. So what is IV Crush? IV Crush happens when there's a sudden drop in the implied volatility, typically after an event such as earnings announcements, news releases, or product launches. It often causes a significant decrease in the price of options, especially call and put options. So, as you guys know, I already like to give you what it is and then break it down to make it as simple as possible. So, as far as implied volatility, so imagine you have a balloon, and please don't laugh. I know sometimes this stuff can be a little hilarious, but nonetheless, sometimes talking about it in this fashion does help individuals understand it just a little bit more, right? And that's what I want to make sure, or what we want to make sure when you guys are looking at this information, or when we're speaking about this information, that is really broken down to its like nucleus, right? So imagine you have a balloon, right? Before a big party, you blow the balloon up really big, expecting it to pop or make a big noise. Now the balloon is full of air, and that air is like implied volatility. Now when the party starts and everyone sees the balloon, the excitement goes away, and the balloon isn't as big anymore. It deflates and the air slowly goes out. So in stocks, this is like when people are excited about something big happening, like a new toy or a surprise, and they expect things to change a lot. But once the surprise happens, the excitement or implied volatility goes away, and the stock price doesn't move as much as they thought. This causes the option or balloons to deflate, lose value quickly. So just like how your balloon goes back to normal after the excitement of the party, the stock's options lose value after the big surprise or event happens. So IV Crush, when the excitement goes away, and so what IV Crush is, it's when the excitement goes away and the option loses value after, even if the stock still moves, because the expectations of big movement are now over. All right? So I'm going to show you guys the example of exactly what happened to me earlier, right? So I originally bought 3 ASML calls, $900 strike price, with a expiring next week, right? I bought these contracts at 75 cents, right? Which is actually $75, right? So when I first opened up my brokerage, this is what I saw. Man, I just knew I hit it, right? But what happened? Maybe 4 or 5 minutes later, maybe even earlier, this was the end result, right? Why? Because, so when I purchased these contracts, I purchased them at a higher implied volatility, which is what we saw here, right? As that volatility began, wait, I think I'm confusing myself. So when I purchased it at a higher volatility, right? Which is what we saw here, which is why we saw when we started making all of this money, right? But now, as that implied volatility started to deflate, this is what the end result was, right? But now, once the market cooled off and that implied volatility start to normalize, this was the end result, which is why I said to Lena, I needed her to go back and look and see if she was now in the green. So how does IB crush happens? Earnings reports, right? We saw that today. News events or announcements, volatility, normalization, right? So the impact of IB crush on options. So I went back and I looked at to see if maybe I can check. Oh, hold on. I just lost all my screens. Hold on. Can you guys still see my same screen?
Yes, we can see it.
Yes, you can still see impact of IB crush on options.
Okay.
The second screen that you, well, the next screen, we can still see it.
Screen is big. I apologize, guys. Give me a second.
It's all good. I lose my screens all the time.
I don't even know how that even just happened.
Yeah.
That's the crazy part.
Yeah, we can still see it.
Neil, if you stop screen share and do it again, you should be able to see it. That may help.
Nope, now I just see you.
No, and then start it again.
Try it
Click,
again.
yeah. Share screen, yeah.
Oh, I see what you're saying. Okay, I got you. Ah, that was dope. Thank you. Now I know in the future if that ever happens to me, I know how to get it back.
No.
So everybody sees the screen again, right?
Yeah.
Yes, sir.
All right, cool. So I went back and I looked at the exact same contract that I originally purchased, right? Looked at number one, the implied volatility. Now look at the asking price, right? Now, I am almost 100% certain that when I purchased this option, that it was not 62.53 implied volatility. And how do I know that? Well, we saw what happened, right? This is what happened. This is what happened, right? So now we started to normalize. This is the end result. Because apparently, originally, had there not been a earnings report and I did purchase those contracts, I would have been purchasing them at 40 cents versus 75, right? So I'm just going to read off what I put here. So call and put option prices. So when IB drops significantly, such as after an earnings report or major news event, the premium of options also drop. This can cause call and put options to lose value quickly, even if the underlying stock moves in the direction the option holder expected. So how it impacts buyers. So if you bought options ahead of a big event, you could be hurt by IB crush, even if the stock moves in your favor. The decrease in implied volatility can outweigh the gains from the stock price movement. For option sellers, if you were an option seller, so that would be the person you would be buying the contract from originally, right? So if you were an option seller, IB crush works in your favor. Why? Because the value of that option you sold declines rapidly, allowing you as the seller to buy them back at a lower price. So now I'm going to break it down a little bit more. So for option buyers, before the party, bought a big balloon or a call or put option, it looked awesome. And you were excited because the balloon was really big, which is technically the option price. It's meaning that the option price was high. So after the surprise is over, the balloon starts to deflate. Now the price of the option drops. So even though you still hope the stock will go the way you wanted, it apparently it did not, right? So for the seller's perspective, if you were the one selling the balloons or selling the options, you actually like it when the balloon shrinks. Because once, I gotta move this out of the way. Once the big surprise happens, the balloon loses air and becomes smaller, which is meaning the option price drops. So now you can buy back the balloon at a lower price, so you make money. Now, this is what I want you guys to see in regards to high implied volatility. This is meta from today, right? Strike price is the 31st. I'm sorry, the expiration date is the 31st. Strike price is 692. Because of everything that's happening with Meta right now, this is what the implied volatility looks like. So now this time tomorrow, I want you guys to look at the same play, and then you're going to see the difference in the implied volatility. Right now, look at the difference between the bid and the ask. That is insane, right? So I guarantee you, if someone tried to get into this play, there is no way that the seller of this contract is taking anything near 1790. Why? Because of what's happening. It's an earnings report, an earnings event, right? So 9 times out of 10, they're going to get this contract as close to the ask price as possible. And me personally, I love to get my contracts closer to the bid as possible. And the reason why is because it actually puts you in the green as soon as you buy it, right? So to minimize the impact of IV crush, you have a few options, right? So you can sell your options before the event, or you can just use a short-term strategy, right? Exposing, use a short-term strategy, right? Gives you less time as far as exposure. So you limit your time exposure by choosing options with shorter durations, preferably expiring the week of the earnings event. Why? The more time you have left in an option, the more its price is influenced by implied volatility. So by choosing shorter expiration dates, you reduce the time premium and minimize the impact of IV changes after the event. Or what you can simply do, you can use a calendar or a diagonal spread. So instead of buying a single long or put, consider using a calendar spread, which means selling a shorter expiration option and buying a long expiration option. Why? A calendar spread involves selling an option that expires right after earnings, which helps you take advantage of high implied volatility before the event. So you buy a longer term option that is less affected by the immediate drop in IV after the event. Or you can use a straddle or strangle strategy, and I believe, John, this is what you use. So if you expect significant movement, but are concerned about IV crush, consider using a straddle, which means you're buying both a call and a put at the same strike price. So, or a strangle, so now you're buying a call and a put with different strikes. So why? These strategies allow you to profit from a large price movement in either direction, while also benefiting from increased IV before the event. However, be mindful that after the event, IV will likely drop, reducing the option prices. So this strategy works best when there is significant movement expected. Or you could just simply trade before earnings, take the gains, or you could just choose not to play earnings at all, right? So again, at the end of the day, what IV crush is, it simply means that when you purchase that option, implied volatility is extremely high. Now, when the event happens, what happens with implied volatility? It starts to decrease, which has a major impact on your gains, right? So, conclusion, IV crush is a significant phenomenon for options traders as it can affect the pricing and profitability of options around major events. Understanding how IV behaves before and after such events can help traders better navigate the market and manage risk. So, in other words, IV crush is when the excitement fades and the balloon shrinks. Buyers lose because their balloon or the option gets smaller, even if the stock moves how they want it. Sellers win because they sold a big balloon and now buy it back for less. So it's like buying a balloon that is super big and fun, but after the surprise, it loses air and you don't have as much fun anymore. Thank you. What questions do you have for me?
don't have any questions, but Neil, that was phenomenal to kind of do that short term, short notice like that. So it was
Thank
well worth the
Thank
wait.
you.
Yeah, it was great.
So does everybody have a better understanding on what IV crush down is?
Yes.
I know I do.
Yes.
Yeah.
Anga had a question. Oh no,
Yeah.
he's clapping. No questions, just clapping.
Is there? Well, I'll go back and rewatch that. But that was that was really good. Just understanding. I've never looked at IV ever.
Nobody does. That's the crazy part, right? But you're busy looking at the ask and the bid, maybe even the delta, or maybe even the theta, right? Nobody ever pays attention to that stuff. Meanwhile, those are the parts of the play that have the biggest impact on your gains.
Absolutely. And we have to remember, guys, we're investors. Our products are the options. So if we're buying things with high IV, then we have to be careful, right? We're cutting into our profit margins at that point. Because we like to get good contracts and sell them for a profit, right? So that's another reason I don't play earnings, because I don't like IV. I don't like you just telling me I got to pay something extra because everybody else thinks something. That's not my thing. But either way, we want to continue to remember that we buy stocks long term, but we trade options. These are our products, guys. Don't forget that. That's why I want to touch on IV today and volume and open interest. So I put those two together. Open interest and IV is something I know a lot of you guys don't pay attention to, but you have to, because the right contract can make the difference between a profit or a loss. That's simple. And we want to buy the best products to make the most money we can, right? Cool. So we're looking at the TV. Go ahead, Neil.
Going back to what I was saying about your options in regards to playing catalyst events where implied volatility is going to rise. The straddle, the calendar play, right? You have to check with your brokerage if you are actually able to do so, right? Because if you're trading, if you have a cash account, which I believe is level 2 options, right? You are not going to be able to use those strategies. You can only use those strategies at level 3, which requires you to have a margin account with at minimum 25K.
Okay.
Right? So,
and again,
playing, earnings can be dangerous for your account, but if you play it long enough to understand what to do before and what to do after, it can be, relatively profitable, right? So you just got to really pick your poison and figure out, definitely really, really sit down and educate yourself enough to see if it's even worth it, right? So, and you got to have the patience for it too, right? Yeah, as you saw earlier, you see how I was down, I think it was like 60% or 30% or something like that. But I also understood once the IV started to normalize, then I'm going to start to see some gains again, right? So, patience is important when you're playing these plays.
Sure. So do we have any questions about anything you guys have seen? Anything you have any confusion on?
I want to go back to
yeah.
John's question regarding, I think John was asking about how do you make that quick decision on the stop loss? So for instance, when you're entering a trade, there's only that very short period of time when there's this confirmation that, yes, it's moving in the right direction and we want to enter this trade, right? But right after, let's say if it starts dipping and it doesn't necessarily continue for another 3-4 candles, what's the best way to prepare before you enter that you can actually set up your stop loss right away, and which is not too close where you get out of the trade in red, but it's the correct stop loss?
You want me to answer that, King, or you?
You go ahead.
All right. So I'm going to tell you what I do.
Mm-hmm.
And this is my process when I'm not able to watch the charts, right? I know Mark loves to do this, and I do it from time to time, and I'm sure King is guilty of it as well. We consider ourselves the stop loss, right? And the reason why we do so is because we're watching the chart, and that's dope. Now, what do you do if for whatever reason you have to step away? Now, this is where it's important to set your stop losses, right? So and I'm going to explain to you exactly how I do it, right? So I find the play, right? I choose, first I pick my entry and my exit, then I find the play. Once I actually executed on the play based on how many contracts I purchased, how much I paid for the contracts, and my patience level based on what's happening with that specific ticker, right? So prime example, where I traded Oklo today, right? I'm not sure if you guys saw me and Shadana going back and forth in regards to Oklo, but I made it clear that whether it turned or not, I was already in a good position. And the reason why is because I already had my stop loss already set. Now, I personally, if I'm going big, I set my stop loss at a minimum anywhere between 2 to 5%, right? Okay. Now, because I literally only bought one contract, and I think I paid, I don't know, maybe 150 for that specific contract, I was only willing to misplace 40% of that, right? So I set my stop loss, instead of me setting it at 2 to 5%, I set it at 40%. And the reason why I did that, because I understood based on my entry point that it had to go down first, right? So because I saw that it had to go down, and based on where I saw the support, just watching it for a little bit, I saw it kept bouncing off support. So what I anticipated it hitting that support again, rejecting, and going right back up, blowing through the resistance. Now, unfortunately, that didn't happen, which was fine because I had time on it. So it didn't bother me. But what ultimately happened, it broke support and it triggered my stop loss. So had I not had that stop loss in place, I would have definitely misplaced more than 40%. By the time I caught it, I probably would have caught it like maybe 60, 70%, right? So again, if you are able to be the stop loss, then there's nothing wrong with that. But if your attention is not on the play, you have to make sure that you set your stop loss even before you go look and see at what's happening. And before you go look to see what's happening with the chart. Because what we tend to do, we get into the play, now we look at the chart. No, you got to finish the process, right? You find the play, find your exit, find your entry, then set that stop loss.
That's your safety net, guys.
Right? So I hope that answers your question. Oh, and I got a question for you, brother. Did that work out for you yesterday?
Yes, it was pretty cool. Yeah.
Dope. Love it. Cool.
So are you clear on that, on God?
Yeah. There's one more question. I think Mark showed this at one time to calculate the percentage real quick in terms of dollar amount. Because let's say if the option price is, let's say $5, right? I guess like we can do the math like real quick, like 5% or 40%. But
yeah, that's what I do. If it's 5% and I'm willing to lose 10%, we know. I mean, excuse me, if it's $5 and I pay $500 for it, I'm willing to lose 10%. That's $50, right? 20 is 100, 30% is 150, 40% is going to be 200, and so on and so forth. 50%, of course, is 250.
But right? Like if we're going long, let's say, right? Like does because the theta would play a role in there too. How do we take that into calculation? Or is it just like plain 5% on the amount that we put in?
Listen, it's simple. If the theta goes against you and the theta is coming off of your contract, if you set a stop loss for 30%, if that contract goes under what did we say? 50, 150. It goes under 350, $3.50. You should be stopped out.
Okay.
No matter what is affecting the contract, because that's what you say you were prepared to lose, 30%. And again, that goes back to the mindset stuff that I was telling you. The stop loss is your safety net. Now you may get to a point where you can go kind of like Neil said, sometimes we don't settle, right? But we have clear intentions on what happens, or a clear path on what happens if we go yay or nay. So we don't really have to set the stop loss, because if it doesn't do what we see it's going to do, we just get out. But starting out, that stop loss is going to save you, and just stick to it. If you say you have $500, you're willing to risk 30% of it, set the stop loss at minus $1.50. What I think you're referring to is option strat. That's to see how much the contract is going to be worth in the future. But as far as setting the stop loss on God, I want you to not complicate this. I don't want you to have to make a decision and go look for a program. 30% of 500.
Oh, cool. Yeah.
Right.
Sounds good.
Yeah, and I just want to make it simple for you, because when I first started trading, I thought I needed everything I saw. And it just doesn't work like that. You have to fine tune it to what you like, right? And I spent a lot of money on subscriptions and all sorts of different things, and some of that stuff I did not use, right? And some of that stuff actually it complicated my process, because I would have to go from one page to another page to another page, and by that time I may have lost good positioning.
Agree. Yeah.
Yeah. So I just don't want you guys to complicate it. I know it's new, and it seems complicated because there's a lot of things going on, and you're losing money and you're making money, and there's a lot of moving parts. But I want you guys to get comfortable, right? And like Michael was saying, sometimes the stuff confuses him. If you can't make decisions on the fly, then stop. Swing trade. If you're good at making decisions after you've had a night to think about it or all day to think about it, then swing trade. Lean into what you're good at until you get better, right? If the day trading isn't working for you, let's try to add more time and give ourselves more time and better products to buy, right? Adding time will save you in itself. The more time you add, the more time you have to make decisions, okay?
Makes sense. Yep.
Sure. Don't complicate it. It's about making money. I don't care if you make the money today or if you make it in a week. $500 a day is still $2,500 at the end of the week.
True.
Whether you made it on a swing or a day trade, your deposits in your portfolio doesn't care.
Yeah.
Okay. Go ahead, Sam.
Yeah, I just said it. So going back on ASML, I'm trying to understand the mindset, because I think when it was going, I get the fact that there was the hype, and then afterwards the price goes down. Implied volatility went up, and then Mark, I wish I would have asked Mark directly, but he then bought. He said he was like adding to his position. So when he added the position, is it because the mindset is then switching towards like, oh, I'm going to then swing trade this? Because we know that for ASML, the hype is down, prices go down, but then afterwards we know that it's going to go back up because, yeah, am I thinking in the right way?
Yeah, he probably averaged down on those
Right.
contracts.
Okay,
I don't know specifically if he was down at that point, but his plan altered a little bit. He saw something that said, keep these, but also let's swing some. And that's fine. Actually, if you see opportunities, you take them. Okay.
Got it.
Does that make sense? Or if it doesn't, we could break it down more.
I think it makes sense. I think from what he did, I'm assuming that it was a switch from, okay, instead of day trading it, then since I have time, I'm going to buy more, because I know that with ASML, with earnings, the market it died down, but it will go up. I think that was the mindset.
Probably, unless he straddled. And if he straddled, he bought calls and puts, and maybe he got out of one to go heavier on the other. I did that today with SPY. I straddled it when we came down. When we started to come down and break those levels, I bought more puts, took some profit off, and then we went back up. And then my calls were up, my puts were down. Then I bought more calls. It didn't work out the best for me, so I had to get out of a couple of those calls, but I did get a little bit on it. But that's just the other case I can see it. But averaging down, as long as it's still a good play, that's fine. Well, we don't want to get in the habit of averaging down if it's a loser. You treat a loser like a loser. Okay.
Got it.
Any more questions?
Yeah, I was curious to know how does the implied volatility drop by so so much? Like even like so let's say like for the ASML, for that one, the high implied volatility the day before was very high, but that so like the contract pre-market was pretty high, but then as soon as the market opened, I saw that the value of the contract went down. But I'm not really sure how that happens when well, at least I think you can't buy or sell the option contracts pre-market. Is that just because of the stock?
Well, the way IV works is speculation. As soon as the hype dies down, you lose that. You lose if IV's at 130, right? When we bought it, or the night before, it's at 130, and tomorrow we wake up and IV is at 30, we're going to lose all of that premium that inflated the contract the day before. Does that make sense?
I think it makes sense. I guess I'm still a little confused on like how the implied volatility goes down without anyone buying or selling.
Because IV is based upon speculation.
Okay.
Right. It's the speculation of the move. That's why earnings contracts that's why earnings are so another reason they're risky. Because if you buy something with high IV, right, and there's a lot of IV, let's say you bought it the day before, after the earnings come out and the speculation dies down, the IV will die down also. So when that contract opens tomorrow, it's going to reflect what the normal range should be, maybe the normal range, right?
So would you say that IV is affected by both fundamental factors and technical factors like news, like anything can affect IV?
Yep. It's all speculation.
Yep. Earnings, news, new products,
See,
it all impacts IV.
Twitter, Reddit.
Demand. So when something happens, a whole lot of people rush to Neil's analogy to blow the balloon up. Am I right? So now we've got a whole bunch of people blowing on the balloon, and then when it dies down, a whole bunch of people stop blowing the balloon. They can't keep it as big. I mean, is that
all it is just the hype, right?
That's the way you get yourself to remember it, Gary. Kudos to you. But yeah, no.
King, if I can mute you.
Funny thing is you can't. No, anyway, guys, I don't want you all to overcomplicate this. We're going to take a look at IV and then we're going to keep it going, right? We don't want to study it. We don't want to marry it. It's just a factor that we know when we're buying it that is going to add to our contracts or take away. Okay? So just when you look at the open interest, take a peek at the IV and the volume. Now, unless you play a lot of earnings, which you guys should not be doing, IV is not going to always affect you that much, this drastic. But so I think, Gabe, what we are trying to explain is what's IV crush. That's what happens when you wake up the next day and the contracts have deflated on you, basically. Because you bought with high IV, and even though you may have been right, even though you may have bought a call and the stock went up, the market is going to take that IV out of it. Once that calibrates, then it's going to be your actual price, okay?
Yeah, that makes sense.
Non-inflated price. So it's just a luxury tax, just like when something new comes out, a new handbag or shoes or even vehicles. I don't know if you guys are into vehicles, but If you're looking at a particular vehicle and you can't get them, then the dealership is going to put a luxury tax. They're going to buy the car may be 100,000 MSRP. The dealership may sell it for 150. Or same thing with watches. It may be one price, but in a gray market, it's a higher price. And if you buy it at the top like that, once the market does calibrate, you're going to lose the equity. Okay. Make sense, everybody? Okay.
Yes,
So
sir.
what we're gonna do is we're gonna start to limit this to one question and one comment only. So if you ask a question and you make a comment, you're done for the day, okay? That's all good. Any more questions, guys?
There is
What's up, man? How you doing over there?
in case and this speaks to volume when looking at the candles. I'm not sure if you guys actually use this on TradingView, and I'm sure you guys have seen it. I think it's like a default indicator, but a lot of people probably get rid of it once they see it. But
Are you sharing your screen now?
yeah, I'm about to right now.
Okay.
Jesus, John.
Somebody got to be the moderator.
So
You're right. You're right. Let me go on mute.
right here. It just simply represents the volume as far as the buyer and the seller, right? Let's go to some live.
XRP.
Boom. Actually,
Oh,
right. So as you can see, let me move this out of the way. The time frame me on 5 minutes. So 15 seconds. So as you can see right here, so if it's red and it rises, that's just the volume for the sellers. And if it's blue or green as it rises, that's the volume and that specific candle for the buyers. So I'm not sure how many people actually look at this, but it is relatively useful, just so you can understand what's happening with that specific candle. And then also the indicator that Randy showed us, the volumatic VIDYA. I went over this the other day, right? That can tell you too, right?
And volume candles. Mark, I think Neil likes to use
right,
them.
and volume candles as well, right? You have volume candles. And what happens if it's a lot of volume, based on if it's the downtrend, then it's fatter. It's a fatter candle. And if the volume isn't there, then it's a thinner candle.
All right, now look at the candle below that, guys. Look at the actual volume candle. It shows what happened.
How it lines up.
What'd you say, Neil?
I was saying, you see how it lines up, how it matches up.
Exactly. That's what I was trying to point out.
Yeah.
And you should show them what you mean when the move is hollow.
When the
so they can visualize it.
Oh yeah, I explained that earlier.
Okay. Maybe I missed.
No, it's all good. Just when we see price going up with low volume, it's pretty hollow. A price coming down with low volume, it's like what's pushing this price when we see those sharp price movements with low volume. I like to say that it's hollow because it's usually not a lot behind it. And you have to be careful because that's how fake outs happen. That's how reversals happen. Because if the price is going up and there's no volume behind it, you got to ask yourself why. What's moving it? Is it the market makers or what's happening here? So you want to be careful when you see that.
Can I just ask a clarification about the volume candles at the bottom? When they're green, that means that the sellers are in control, and when they're red, it means the buyers are in control.
Other way around.
Wait, what?
When they're green, the buyers are in control, right?
Right.
That's the buying volume. And when it's red, it's the seller's volume.
Yep.
Yeah.
Okay.
Before we tap out, I did.
You good, Joy?
Wait, huh?
Yeah, I'm gonna have one more question though, and that's about these volume candles. When I tried them before, does it take the wicks off of the candles? I can't see it because I'm looking at my phone. so I can't really see the detail of your candles. But it doesn't take the wicks off the candles when you change the volume candles.
No,
The wick is there.
The wick is there. Okay, thank you.
It just seems relatively small, but the wick is there. The only way
Okay.
the only way you will never ever see a wick on a candle is if it's I think it's the Bazu. I always jack that word up. But if a candle, let's say for example, if a candle is only bearish without any type of interference from a seller, that is the only time you will not see a wick, because there's no interruption. So it just simply opened and that momentum just kept going up based on that time frame. So let's say, for example, we're using the 15-second time frame. So from the open of the candle up until the close, there was no type of opposite interaction. So if it's a buyer's candle, there was no seller interruptions, or if it's a seller's candle, there was no buying interruption. And for that specific time frame, and then it moved over to the next candle. So that's usually when you will own. That's usually the only time you will see a candle without a wick.
Okay. Thank you.
you good, Joy?
Yeah, I'm good. Thanks.
Okay. Any more questions, guys?
Neil, on your chart right now, you have that like parabolic SARS, I think it's called, like the dots with the red and then the dots with the green. The dots with the red, the price that's there, does that reflect like a selling price, and then the dots with the green is a buying price? Because when I actually look at the candle, sometimes the prices on the red, the red square doesn't always match up with what's like on the candle.
So all those numbers represent so it's at that specific price when it turned. So for example, this turned into a buyer's opportunity at $3, and I don't know why they have this so small, but it turned into a buyer's opportunity at the $3.08 mark, right? So then once it ran up and then it switched back to a seller's position, that was at the $3.08. Wait, $3.08. $3.0878. So then at 30878, we got that specific price point, and then it turned into a seller's position. So now we went down, and once we hit 30783, that's when now it became a buyer's position.
So those are like buy and sell signals. Like when you see them pop up, that's like red is like a sell and green
Right.
is buy.
You can take it as a buy signal or as a sell signal. It's really up to you how you want to interpret it. But it just simply means that when it switches, so for green, the buyers are now in control of the momentum, and then when it's red, the sellers are now in control of the momentum.
Got it. Thanks, Neil.
No problem. So if you guys are into seasonalities, right? What that simply means is that I'm trying to understand how a specific ticker is going to move in specific months. So I found this really cool indicator right here. It's called let me actually show it for recording purposes. Y'all know me, I'm always looking at different indicators. So whenever I find something that I think is beneficial, I will always share it.
Yeah, I wouldn't have known that from looking at your indicator list. I wouldn't have had a clue. You're only at the P's.
Man, oh man. Hold on. Whatever it is, the market performance. And it's relatively cool. I'm still learning it. I just started looking at it today. All right, it's by Lux Algo. Lux Algo, as you can see, it is relatively new. Only 14 people are using it right now.
Yeah.
All right, so the market performance by yearly seasons. All right, so I'm not going to break it down for you guys. If you guys decide to use it, I want you to get in the habit of breaking it down on your own. But again, just to summarize it, it just really tells you the opportunities in specific seasons, like literally, right? So if we're looking at XRP, autumn is where all the buying happens, right? And then it also breaks down how the seasons are broken down as far as the months, right? So you have your autumn, September to November, winter, so on and so forth, right? And it's even what's even more dope about it, it gives you to you from an astronomical level, right? Equinox, solstice, pretty dope.
Okay. And that's showing the seasonality. Seasonality is just basically when something is moving in a certain season. So I know we looked at that. We had a lot of plays on like PayPal and Square and Affirm and things like that during the holidays. Randy, no, Lulu, we smoked them. Seasonality play, right?
Yeah.
Around the holidays, those types of tickers are going to move.
Firm.
Well, usually. So, I mean, of course, we use it like everything else. It's just something to help our thought process and just more confirmation. And that's what we're looking for. Do we have any more questions? It's about 8:04. I don't want to keep you guys too much longer unless we need to. Do we have any more questions, comments, or concerns? The comments and concerns I'm not concerned with. So any more questions?
Everybody good? Everybody at least have a better idea or a better understanding on volume?
Definitely, yeah. It was very
I
helpful.
hope so. Only 3 people talked. Everybody better understand it.
I thought,
that was real good.
I thought it was great.
You made a
That was
great
real good.
presentation.
Okay, cool.
So, John, real quick, I actually got a question for you. So,
Yes, sir.
what was your, and you probably didn't even pay attention to it, but what was your strike price and expiration date for your meta play? I think it was meta you played.
Yeah, give me 1 second. I just had to put up. I think it was, let's see. I think it was I did 8% at whatever that current price was right before the close of the bell. And so I did, let's see, I brought one contract. It was a 250, no, not 250. Let's see. Yeah, February 21st, 225. It was a 700, and I hate fidelity because I can barely see this. Can't even see my thing. I think it was 730, if I'm not mistaken. 735 call, right. So it was February 21st, 225, 735 call.
Okay. Cool. And are you up now?
Well, I mean, I don't have Robinhood, so it's not going to tell me after hours as far as where I'm at, but based off of what I'm seeing after hours in Robinhood, I'm up.
No, I'm talking about, wait, did you see gains before the market closed?
Oh, actually, no. I was down 27% before the market closed.
Yeah. Be ready tomorrow. It's gonna hurt your heart.
That's why I'm in this class.
Okay.
I haven't learned.
It's all right, guess what? You just paid for a lesson. So that's okay. Right?
I'm gonna stop recording there, guys.
Next time.